Welcome back to the Florida Real Estate Investing Masterclass. Now, you've learned how to find and analyze great deals. But there's one more piece every investor needs to master: financing. The truth is, your funding strategy can either make or break your deal. In this module, we'll cover the main ways Florida investors finance properties, from all cash closings to creative methods that require little or none of your own money. At the end, you'll know exactly how to pick the right financing option for your goals and current resources. Every type of deal flip, rental, or land could choose, requires a different funding approach. Cash gives you speed and flexibility. Loans expand your buying power. Partnering or creative finance helps you grow even when capital is tight. Think of your financing plan as part of the deal's foundation. A solid structure gives you peace of mind, confidence with sellers, and stronger long-term profits. Part 2, cash deals. Unanimous, fast, simple, and powerful. Cash deals are king in Florida, especially for land transactions and quick flips. It's fast, simple, and powerful. Sellers love cash because it eliminates delays, appraisals, and loan contingencies. Pros: fast closings, often within 7-14 days. Strong negotiating leverage cash buyer status often earns discounts. Simpler paperwork and fewer fees. Cons: ties up your liquid capital. Limits how many deals you can do at once. If you're starting out, focus on small cash deals. Maybe a vacant lot or affordable home. As profits build, you can recycle that money into larger investments. Part 3, traditional financing using banks and mortgage lenders. Conventional loans still make sense for long-term rentals and primary residences. In Florida, lender options include local banks, credit unions, and national mortgage companies. You'll typically need a credit score above 620, a down payment of 20 to 25%, and proof of income and reserves. Traditional financing brings lower interest rates and long amortization, ideal if you plan to buy and hold. But it's slower and less flexible than cash, which is why active investors often combine both: traditional loans for stable assets, cash or private money for rapid deals. In Part 4, private lenders chain, relationship-based capital. Private money is one of my favorite tools. These lenders aren't banks. They're individuals or small companies who fund deals for a return, usually 8 to 12% interest, secured by the property itself. Flexible approval, based on deal quality, not just credit score. Quick closing, often in 5 to 10 days. Negotiable terms TAND. You can structure interest-only payments or defer interest to closing. Finding private lenders takes networking. Attend Florida real estate meetups, investor clubs, or even LinkedIn groups. Present solid deals with clear profit margins, and you'll attract funding partners naturally. Tip: always secure agreements in writing and have an attorney. Drafted the promissory note and mortgage as requested. Your professionalism builds trust. Part 5, hard money loans. Short-term fix and flip funding. Hard money lenders are professional firms that specialize in short-term loans for investors. They focus on asset value rather than borrower credit. Loan to value 65-75%, interest 9 to 13%, points 1 to 4 upfront, terms 6-12 months. Hard money works perfectly for flips where speed and leverage matter more than interest rate. Just remember, every day you hold the property costs money, so efficiency and good contractors are key. Part 6, creative financing strategies for Florida investors. Now let's talk about creative ways to buy property when cash or credit are limited. These strategies are perfectly legal and powerful when used correctly. 1, seller financing. The seller acts as the lender. You agree on price, down payment, and monthly terms. Common in land deals or older properties owned free and clear. 2, lease option, rent to own. Control a property with the option to buy later. Great for testing rental markets or improving credit before full purchase. 3, subject to existing financing. You take over payments on the seller's existing mortgage while title transfers to you. Requires the seller's consent and clear documentation. 4, joint ventures (KEL). Partner with someone who brings funding while you handle acquisitions, repairs, and resale. Split profits according to contributions. These methods allow growing with limited capital, but transparency and good contracts are non-negotiable. Always involve an attorney familiar with Florida law. Part 7, how to choose the right option. Ask yourself 3 questions before deciding how to finance. 1, what's my timeline? Pay, quick flip, or long-term holdout? 2, what's my risk tolerance? Do I prefer security or speed? 3, what's my available capital and credit position? Guidelines: short-term, high-profit flips, hard or private money. Long-term rentals, conventional financing. Land or fixer-uppers, cash or seller financing. Limited capital, creative partnerships. Mixing strategies is common. Many Florida investors start with private money to secure deals, then refinance into longer-term loans once the property stabilizes. Part 8, demonstration example. Here's how funding changes profit. Flip example, purchase price, repairs $4,280,000. If using cash, your net gain after cost might be $35,000. Using hard money at 12% interest plus 2 points for 6 months reduces profit to solid but less flexible. $27,000 still. Understanding cost of capital helps you decide which method preserves more profit overall. Building relationships with lenders reduces profit to $27,000. Still solid, but less flexible. Still, understanding cost of capital helps you decide which method preserves more profit overall. Financing isn't just numbers pegged. It's people. Building trust with lenders pays long-term dividends. Show deals, not dreams. Repay early. Keep detailed records of each project. Sending progress photos and updating small gestures builds credibility. In Florida's investor-friendly climate, reputation is your credit score. Let's look at common financing pitfalls. Focusing only on interest rate instead of total loan cost. Failing to secure written agreements. Borrowing short-term money for long-term projects. Over-leveraging cash. Taking on too many loans too fast can be a trap. Sustainable growth beats rapid risk every time. Let's recap what we've learned and transition to... Cash deals offer speed and leverage in negotiations. Traditional loans fit stable, long-term assets. Private and hard money lenders let you scale fast. Creative financing unlocks opportunities when capital is tight. Finance doesn't have to be intimidating, hell. It's just another tool in your investor toolbox. Once you understand it, you can structure deals in ways that work for both you and the seller. In our next session, Module 7, Buying Vacant Land, we'll focus specifically on Florida's land market, zoning, development potential, and how to turn empty lots into real profit. Thanks for watching Module 6, and I'll see you in the next lesson.